Hi, my name's Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, in today's episode, I want to talk about cash flow management. In Wealth by Design, I talk about the wealth formula, and the wealth formula has three components to it. And the formula just, I think, helps you really understand what are the important parts of investing that are going to really move the dial, and it encourages you to then focus on those fundamentals. But I think if we express it, how do you build wealth into an equation? I think it does allow us then to understand that there's compounding benefits of getting multiple things right. So the wealth formula is your surplus investable cash flow multiplied by your investment efficiency multiplied by time. And each of those three components compound over time. They multiply each other. So, of course, if you don't have any money to invest, if you don't have surplus cash flow to be able to, fund borrowing expenses to invest or to invest in of itself, like as in invest in the share market or make super contributions or so, well, then, of course, multiplying nothing is still nothing. Right. So it starts with that surplus investable cash flow. The investment efficiency is really about how much of the return are you keeping, and the drags there are fees and tax. So, and then also decision making as well. Actually, they're the three drags. So, of course, fees are obvious. Tax is really around income versus capital growth. If you receive a realized capital gain or income in a year, you'll pay tax on it. If you have unrealized capital growth, of course, it compounds each year. And then the decision making is really, if I'm making a lot of short term decisions, like if I'm share trading, for instance, and my average holding period is a month, then every month I need to make a new decision of where to put that money. Whereas if I can find an asset that is fundamentally strong, that's going to compound over time, I make one decision, I get that decision right, and I sit with that decision for the next 20 or 30 years. That's what's going to compound. So that's the investment efficiency part. And then the last bit is time. Makes sense, right? There's a saying, I quite like the Warren Buffett saying that you can't make a baby in 1 month by getting 9 women pregnant. Of course, some things just take time, and building wealth is one of those. So I guess if we return to that calculation, the absolute starting point's got to be cash flow management and investable surplus cash flow, because without it, everything else is pointless. Without a surplus investable cash flow, this podcast is pointless. And so I've recorded some episodes on cash flow management before, and what I want to do today is greatly enhance the approach, because what I've really spoken about previously is you can't manage what you don't measure. So you need to measure where you're spending your money. That's kind of the starting point. And then you need to rely on discipline to stick to a plan in terms of carving off a surplus investable cash flow. Well, I want to change both those points. But just as a refresh, in the past, I've said go and download 3 months of bank statements, transaction listings from internet banking and so forth, and go and categorize your expenditure in a number of different categories. In fact, I had in past blogs 3 non-discretionary categories and 4 discretionary categories. And the idea behind that was 3 months is probably kind of enough to give you a little bit of a pattern, but it's not too much data that it starts to become laborious to trawl through all those transactions and allocate them. But in reality, it was a tedious process. And also, it tells you what happened in the last quarter, but it doesn't tell you whether the last quarter was typical of your spending habits. And there's going to be annual expenses in that quarter, that only occur on an annual basis. Could be a holiday, could be insurance, premiums, school fees, these sorts of things. But it was still an eye-opening activity or exercise, because, when we speak to new prospective clients, very few of them know what they spend each year on different categories. And you don't have to tell me, how much do you spend on each individual category, but, what are your non-discretionary expenses and what are your discretionary expenses? Because splitting them up like discretionary, non-discretionary is important, because I know the non-discretionary ones we can't compromise on. The discretionary ones might have a little bit of fat in them that we can tinker with if necessary in order to execute a strategy. So it's important that I know that split. And of course, just quickly, non-discretionary expenses are things that you can't really overspend on. So it's going to be utilities, mortgage repayments, insurances, things like school fees, those sorts of things, that the cost is fixed and there's little you can do with it about it, I should say. Now, of course, you measure utilities, bills and so forth and shop them around every year. So, of course, you can make sure you're not getting ripped off. It is what it is, right? Whereas discretionary expenses are like going to the supermarket, because, a visit to the supermarket is never cheap, but a visit to the supermarket can cost you $200 or it can cost you $500. I mean, it's very discretionary, eating out, these sorts of things. So anything that, you could spend $1 this week or $100 next week is probably going to fall into discretionary category. Now, one of the big enhancements to this cash flow management strategy is AI. So I now use Claude to categorize transactions. And look, I do this on a monthly basis. So I go back and have a look at what do we spend last month and put it into certain categories. You don't necessarily need to do that. I do that because I feel like that gives me sort of better visibility and decision making over what we're spending. But, it just depends on your lifestyle and what you're doing and your priorities, because, I'm lucky enough, my wife and I are lucky enough to be in a situation where, kids are relatively independent. We don't have a home loan anymore. So we don't have, when you're younger, you've got a lot of commitments going on and your discretionary spending is pretty little anyway. Like most of your income is soaked up through mortgage repayments and kids' costs and all these sorts of things. So cash flow management is important, but it is what it is. Whereas, at other stages of life, you can go off the rails. And my wife and I, if we didn't manage it, that's very possible. So I like to do this every month, and that I use Claude in order to do that. But look, other models will probably do just as well. They won't do just as well, I don't think. Other models can probably do it, but I find Claude is much better. So out of the three or four main models, Copilot, ChatGPT, Claude, and Gemini, I think Claude is certainly a standout when it comes to financial analysis. You can have a free account. I think, we have a paid account at work, but you can use a free account. The benefit of using AI to do this is, firstly, you can, and I'm going to share a prompt that you can use, but you can refine your prompt over time that can learn then how you spend money and how to categorize different expenses. So the more you use it, the more efficient it will become. And here's the big benefit though, is that the amount of data you give it doesn't really change to a large extent how much effort it's going to take to analyze that data. So if I said to clients, go away and download 3 years of living expenses and go and allocate them, that project's probably going to take a full day or maybe more, depending on the number of transactions. Most clients are going to tell me where to go. Like, most people aren't going to do that. That's the benefit of AI, is that it can do that. And there's great benefit in analyzing trends over time, because it will let you see and analyze and measure, has there been any drift? Is there any lifestyle inflation going on that you weren't really aware of? And so it can look at, how much was your discretionary spending 3 years ago and how much is it today? You should expect, it's reasonable to expect an uplift because of inflation. Things just cost a lot more. So you might see a 10% increase in those costs. That doesn't mean you're spending more. It just means it costs more. But it's important to measure these sorts of things. But if you see something greater than 10%, that's probably more than inflation. You can also then measure consistency. So are there months or quarters where, expenses are much higher, maybe because of more lumpy expenditure, and that again will help you kind of manage and navigate those quarters or months. And also, if it's consistency around discretionary spending, then it's a sign that you might not have the right process or system in place to manage your cash flow, because if you might be relying on discipline to manage cash flow, and that's not ideal. Discipline's like motivation. It can change from day to day. I'll come back to that point because that's the sort of second part of today's podcast. The other benefit of using Claude is that it can really help you understand where your money's going, because you can get it to produce charts, insights, analysis, and it can get into a really granular level. And knowledge is power. You can't manage what you don't measure, and being able to measure it at your fingertips, and to the dollars and cents, I think gives you a sort of powerful insight. The other benefit of using Claude is that in reality, people tend to fall into kind of two cohorts. in my experience, talking to people advising clients over a long period of time. So the first cohort is the cohort where they go, well, I'm really surprised we're spending this much. We don't live an exuberant lifestyle. It's not like we're going out to fancy restaurants every week or anything like that. So I just don't understand how we're spending so much on general living expenses. In that situation, the leak in terms of spending on things that aren't really adding to your standard of living is probably in lots of different categories. And so it's going to be hard to sort of pick up. But this is why, Claude is so useful, because we can look at 2 or 3 years worth of data and we can really drill down and get it to understand and categorize and find, where we're spending the extra $10 a week on, a bunch of different categories, for instance. The second cohort, and this is the cohort my wife and I fall into, is that we're pretty okay at managing money. There's only going to be a couple of categories where, if left unchecked, we could overspend. So for me, and I call it an investment rather than spending, but for me, it's wine. I love to buy red wine. I love red wine. Very interested in it. It's my hobby, if you like. And my reality is that I could find a bottle of wine that I'd like to buy every single day, or more than a bottle. And, there's an insatiable appetite there in terms of, collecting wine. So that is one of those categories that I want Claude to account for separately, because I have a clear budget in mind of what I want to spend in that category every year. And I'm making a deliberate decision, because wine's great, but, experiences are better. I know they will enhance my life a lot more than a bottle of wine, because once you've drunk it, it's gone. Experiences are in your mind forever. So we just want to make deliberate decisions. My wife and I want to make deliberate decisions on how much we're spending in those categories where we know we have, an affiliation with, and we really want to be a little bit more proactive around it. So I guess you just need to kind of self-reflect and work out, which camp do I fall into. So as I said, there's a link in the show notes to the blog on the website. The blog on the website has a prompt that you can download and you can put into Claude. You then go and download Excel transaction listings, from your credit cards, from your bank accounts. It can be just PDF statements, it can be screenshots. Claude will read it all, but get all the data into Claude. I'd probably say, look, start with a shorter time period first, maybe 3 months, maybe a year, because you can then and give it more data as you kind of train the prompt. And then the prompt will ask, are there any specific categories you want me to categorize separately? So I've got it to categorize into 7 different categories, as I said, the 3 non-discretionary and the 4 discretionary categories. So that's kind of the standard, and that's a good starting point, but it'll ask you, is there anything else you want to account for separately? So if you're like me and you like wine, put wine in as a separate category. And then what it will do is we'll go and analyze the data, and it will categorize the expenses, if it has a high confidence, into those categories. It will then give you a spreadsheet of uncategorized expenses. And then what you can do is put notes in that spreadsheet, save it, and then re-upload it into Claude. And you can do that a few times, right? So if you know that there's some transactions that are all the same from the same vendor, you don't need to note each one. You can just tell it, any transaction from XYZ store, allocate to this category. And you can have more conversations with it in terms of asking it to break categories into subcategories, for instance, give you a little bit of analysis on spending patterns, or ask it, I'm looking for savings, where do you think I can save money? All those sorts of things. Claude's pretty smart, and it might take you, a few different conversations. I just want to say, it is very quick, in terms of, it'll do in literally minutes what would maybe take you, 3 or 4 hours. But the thing is, it'll just become quicker and more accurate and fast the longer you use it. So the last bit, once you've done that analysis and you're happy with the analysis in terms of the categories Claude's using and the accuracy of the allocations. So once you're happy with the analysis it produces, and if it doesn't do this automatically, it might do it automatically. But what you write then is, all you need to write is, I'm happy with the analysis. Now please generate pass 4 personalized prompt as described in my original instructions. And it refers to pass 4 because there's 4 different passes to this, 4 different cycles or processes to this prompt in terms of analyzing expenses. expenses. But what you're asking it to do is now sort of update the prompt for everything that it's learnt in the conversation that you just had with it. And essentially every time you do this analysis, your prompt will get better and better and more customized and personalized to your situation. And that means you'll have fewer kind of uncategorized expenses to recategorize. That's why I think when you first use the prompt, maybe start with 1 or 2 months worth of transactions. And then as the prompt gets better, expand the data set. And then you can, after doing it a couple of times, I get excited about it, right? So I'm a bit of a nerd, but it's so powerful and gives you such great insights and useful insights that then you can feed it, 2 or 3 years worth of data and it'll give you, heaps of data to go off. Now, Claude is a very powerful tool, but there's a couple of things that you just need to be careful of. First thing is that Claude won't necessarily be able to identify whether expense is genuinely a once-off expense and not a reoccurring item. So it's something that you're going to need to be careful of. I guess you're probably going to remember a material once-off expense if it occurs, and then you can kind of pick it up and adjust for it, and you can tell Claude, just categorize this as a once-off expense. But also the other thing is just be careful about how you categorize once-off expenses as well. So for example, household maintenance, something breaks down or needs repairing in your home, certainly that's a once-off expense because you don't necessarily think that the same thing's going to break next month. But things break at homes and you're going to need to do certain level of maintenance and repairs. So just be careful about categorizing something as a once-off. It might be a irregular expense, but it might be something that you do need to provide for in your cash flow budget. The second tip is just strip out any sensitive personal information. Things like account numbers, names on statements, BSB numbers. That's why downloading transactional data into a CSV file or Excel files a bit better, because you can remove that as opposed to uploading PDF statements. But really, Claude only needs the date, the transaction description, and the amount. It really only needs those 3 things to kind of work it out. So AI tools, just be careful about any information you upload to any online tools, of course. And of course, paid accounts are going to tend to offer different levels of security and privacy, and whether it trains on the data you give it, those sorts of things. So I'm not a IT nerd, and I'm not sitting here saying it's fine, put everything in there as well. You got to do your own due diligence around whether you want to utilize these tools or how you utilize these tools to the best of your ability while maintaining data security as much as possible. Okay, so I think this process of using Claude to analyze data, and you can do that, as often as you'd like to do, is very empowering because it allows you to understand where money's going. And the thing is that it's hard to conceptualize because it's so many different transactions, and a lot of those transactions aren't visible, as in most Australians don't use cash anymore. It's tap and go, it's automatic direct debit, it's Netflix subscriptions, all these sorts of things. And they're insidious because you're not taking money out of your wallet, actual hard notes out of your wallet, and paying for those expenses every single time. So they're not obvious, they're not visible, and they're easy to underestimate. And that's why it's really powerful to, educate yourself around where money's going and then make really important and deliberate decisions. It's something that I've spoken about before in terms of things like a holiday expense. We think really consciously about it in terms of where we want to go, how we're going to get there, where are we going to stay when we're there, what quality accommodation, what activities are we going to do. And we think about it in terms of, okay, this is the cost and this is the benefit, this is the enjoyment we're getting from that expense. If we were that conscious with every expense, it'd be much better because we wouldn't waste money on things that don't matter. We're only then going to spend money on things that do matter. And so this better data helps us make more conscious decisions. So if you work out, for instance, that you're spending $10,000 a year on buying lunch at work, or 20,000 or whatever it is that's going to sort of raise eyebrows. And then you can think about, well, it's a bit lazy. Maybe I should just be a bit more organized. I'll bring my lunch in and I'd rather allocate that money to a better holiday at the end of the year, or investing, whatever it is. But making more conscious decisions is really important. But having said that, this is where the biggest weakness lies, is it's a behavioral problem. It's okay to make the decision. I make the conscious decision. I'm not going to buy my lunch anymore. At least I'm not going to buy it every single day. But don't rely on willpower. Don't rely on you changing your behavior. That's the issue. You've got to try and automate that decision. So we want to make the conscious decision, but we only want to make it once. And then once we've made it, we want to implement an automatic strategy that makes sure that, I follow through with the decision that I've just made. And the most effective cash flow management is the kind you don't have to think about because it's automated. And it really comes down to having a well-designed banking structure that makes good decisions automatic and bad decisions inconvenient. And you can do that really using 3 principles. The first principle is pay yourself first. So as soon as income arrives in your account, set aside the amount that should be directed to either saving, investing, debt reduction, or anything else that is a priority. Treat it like a non-negotiable bill. The key is you don't need to rely on discipline every pay cycle because it's done automatically. You just set it up once, and every single pay cycle, that money is going to be carved off. So if I return to my original example about buying lunch at work, decide, okay, I'm not going to do that anymore. I'm going to allocate, of the $10,000 a year I'm spending on that, I'm going to allocate 5 towards a holiday. And so then you set up an automatic pay direct debit or through your employer and say, okay, move this X amount per pay into this savings account, this separate savings account that I'm going to use to fund my holiday. Okay, the second principle is to isolate discretionary spending. So every month, transfer, or fortnight or week, depending on how often you get paid and how often you want to do it, transfer a set amount into a discretionary spending account and use that to pay for all discretionary expenses, including credit card repayments. If you use the credit card for a non-discretionary expense, that's okay. Just repay that transaction immediately using your normal kind of everyday account, not your discretionary spending account. That way, the ongoing balance on the credit card is just discretionary expenses, and at the end of each month, out of your discretionary expense account, you can repay the credit card. The benefit of doing this is that you get to track your discretionary spending without necessarily tracking every dollar as you spend it. So you can use the Claude analysis to work out, okay, what should my discretionary spending should be? What would I like it to be? And so if I say, well, it's, $5,000 a month, then I put $5,000 a month in this discretionary spending account. If I'm halfway through the month and the balance is nearly zero, I know something has gone awry. If I'm almost towards the end of the month period and I've still got a couple of $100 left in that account, I know that I've achieved my goal. But you'll unconsciously become more conscious about spending if you have that mechanism, that automatic mechanism that allows you to sort of judge kind of where you are relative to where you want to be in terms of your spending amount. And because discretionary expenses tend to come in a lot of very small amount transactions, small dollar value transactions, it's otherwise too difficult to manage it unless you track every single expense, and very few people really want to do that. It's tedious. And the third principle with automating your cash flow is keep your savings and investing out of sight. So if you think it's going to be tempting, if you do have some challenges sticking to a plan or having that discipline, keep it out of sight. So if you know you want to repay a certain amount off the mortgage, get your employer to transfer a certain amount, set amount into the offset account or into the mortgage itself even, and then, remove that savings account from your online banking profile. So just hide it from the profile. Just means it's kind of out of sight, out of mind. If you want to see what's going on, of course you can see what's going on, but at least it won't be that tempting to necessarily draw money out of that account. And similarly, if we put money into a loan, you wouldn't do it for an investment loan necessarily, but for a home loan, it's okay. If you put money into a home loan, you have then the psychological barrier of if you want to take those savings out again, you've got to redraw. And so that's what I'm saying. Make the banking process automatic to do good things and inconvenient to do bad things. And it's inconvenient to unhide a savings account so you can see how much money is in there if you want to dip into it. And it's inconvenient to redraw, feels bad to redraw from a home loan. So they're the 3 principles, but the overarching theme is try and make it as automatic as possible. Now, these 2 enhanced processes for managing your cash flow kind of work hand in hand. So the AI analysis really gives you the accurate evidence-based view of what you're actually spending, allows you to sit back and make more deliberate decisions on how you want to allocate your income and using reliable data in order to make those decisions. And this works both ways, by the way. Your spending philosophy might be that if you can afford to spend more, you will, but you'll always prioritize financial safety. So for some people, it might mean spending more. Maybe if they've got themselves into a financial position, where they're already financially secure, you can make some more deliberate decisions. Okay, what do we want to spend on holidays this year? We've done all the heavy lifting in terms of the previous sacrifice. We can now sort of loosen the belt a little bit and make some more deliberate decisions with, how we're going to utilize that wealth moving forward. So it's not only just about reducing expenditure, it's really about making conscious decisions. It could be just we're going to spend the same, but we're going to reallocate it to a different category, a category that's going to give us, more utility, more satisfaction, better lifestyle, so forth. So that's kind of the first step. The second step, obviously, then is automating those decisions. And the idea is that you would revisit this analysis periodically. Now, how often is going to depend on your circumstances and motivation and all these sorts of things, but I'd say do it at least every year. Every year, just to review, is there any lifestyle inflation going on? Am I really happy with how we're spending our money? Do I get that utility and satisfaction from how we're doing it? And if I'm unhappy and I want to make some changes, how then do I automate that change so I don't need to rely on memory or discipline in order to do it? And also, when your circumstances change, you can also make that decision. So if you get a bonus or an income increase, you can decide, okay, how much of that income increase am I going to put towards building my financial future versus improving my current standard of living? So I think this approach to cash flow management is a bit of a game changer because, in the past, it's been very tedious. We've had apps that, used to allocate, expenses. Online banking does that to some degree as well. But I think AI is really taking it to the next level. It becomes less tedious. And the more that we use it, the more it learns, the more accurate it becomes, the less tedious the whole process becomes as well. And then I think by taking the approach of automating the cash flow management decisions, that just increases the probability we'll be able to achieve success or achieve our goals. And remember the wealth equation, as I started off today's podcast episode by talking about it. The first part is an investable surplus cash flow, multiplied then by investment efficiency, multiplied then by time. And so that first part of the equation is the most important because that's kind of what you're feeding into the funnel. And then, of course, the discussion that we have is mostly in this podcast is really about investment efficiency, and then time will just do its thing. Okay, in tomorrow's episode, which is number 6 in the series of 8, I'm going to talk about investing in shares in an evidence-based way, so how that rule has changed since Investopoly. And next Wednesday, I'm releasing my report, How to Choose the Best Super Fund for You. It's the first edition of that report. I will be updating it every year. As loyal listeners of this podcast will know, each year I do an episode on super fund returns, who was the best fund last year, and some commentary on how to choose a super fund. Like I said, I've been promising over the last year or so, I've taken that analysis to the next level and produced about a 34-page report on how to choose the best super fund. I know it sounds laborious. You don't need to read the whole thing, just the bits that will help you make a better decision. And I've got some flowcharts and matrices in there to help you make that decision to prioritize what's most important in your circumstances, as well as a checklist that you can follow. So there's a lot of information in there, and my goal is to update it every year. And people can use as a resource just to make sure they're on the right track. Choosing making sure your super is invested wisely, the right structure to reduce tax and fee drag and invest in a way that's going to maximize long-term returns is an incredibly important decision. I'm not saying or suggesting, in fact, that people need to switch super funds regularly. Hopefully, in fact, that's not the case, that you make a decision, but you review it annually. But, if you made the right decision from the outset, the chances or probability of needing to change down the track are reduced, but just making sure you're on the right track is important. Anyway, that's next week. There's a lot of information in there, and hopefully it's a resource that it's a shareable resource as well. So, if you know anyone that doesn't listen to the podcast that you can utilize the report, please share it with them. The more the merrier, of course. Okay, that's next week. Look forward to sharing that. Until then, bye for now. Before I go, my new book, Wealth by Design, is now available for pre-order. Pre-orders matter more than you think. They're used by bookstores and online retailers to decide how many copies of the book to stock. So, as a huge favour to me, if you're considering buying the book, I'd really appreciate it if you pre-ordered it now rather than wait. And the part that I'm most excited about isn't really the book itself, it's the AI companion tool that I've built to go with it. I reckon it's a game changer, and I'd love you to see why. The pre-order links are in the show notes. Thanks a lot.